Let's, for example, look at NVIDIA. Financials. It's down again. Oh, it's up in the market. Okay. Income statements. Let's look at quarterly. In the trailing 12 months, that's what TTM means. They have R&D cost of 10.5 billion. You know, NVIDIA being a company that generates new technologies all the time, you might think that's reasonable, but not all of that is true R&D costs. If you go to statement of cash flow, which is not something we use quite a bit, but look at it, its stock-based compensation is $4.1 billion. Anytime you give the CEO a stock option, you have to attach a value to that. How you do it is not the topic of this class, but you have to attach a value and amortize that over the so-called vesting period. Most of these options have a life of 10 years, but the first 3 years, you can't do anything with it. That's called the vesting period. It's, in a sense, deferred compensation, right? So true R&D cost is probably about $6 billion. It's not a small amount, but it is not. I mean, their net income for 12 months is about 53 billion. So 6 billion is still about 10%. By the way, part of this cost of goods sold, even though you're not going to see it in the income statement directly, it's the depreciation and amortization and that sort of stuff. Remember, depreciation is the non-cash cost, but it's still part of the income statement. Then you have the operating profits or operating income. I don't know why this thing is so low. Let's have it high. Gross profits minus operating expenses. You could also express that as a percentage of revenue. Then you call it operating margin. For example, if you looked at NVIDIA, income statements, their operating income is 59,582. And that's roughly 60+% of their revenues. So that means before we have to worry about some other stuff, you know, financial income, taxes, and all sorts of stuff, for every $100 of revenue, NVIDIA keeps slightly over $60 in. And then there is also so-called non-operating interest expenses and income. You know, if you have a lot of cash, you're going to invest it in something that's going to generate interest income, or if you have debt, you're going to pay interest on that. Apparently, NVIDIA has both of them, but net, they make about $1 billion every year. It's going to be probably more because this is only trailing 12 months, which, and just like anything, you also have other stuff depending upon the company. Sometimes you have special charges. that kind of varies. You get the pre-tax income. I don't know what happened to my keyboard. So earnings before tax. By the way, this operating income before interest and taxes, it's the same thing as operating income. And we're going to abbreviate that to EBIT. The earnings before tax, EBIT minus net interest expense. If you have net interest income, obviously, that's going to be negative expense. Remember, in accounting, a negative expense is revenue or income, or negative income is expense in a sense. And net income is simply EBT, and we abbreviate that to NI. That's going to be EBT minus taxes. Let's see how much tax NVIDIA has paid. About $8 billion out of a pre-tax income of 61. So that is about 15%, I think. Let me see if this is going to work for me. No, doesn't want to work. About 13%. You're probably thinking, that sounds low. Well, the US corporate tax rate is 22%. And NVIDIA is headquartered in California. If I'm not mistaken, California corporate tax is around 10% range. I'm not even talking about any local income taxes. Why is this actually a lot less? That's because a lot of these corporations keep their tax headquarters in different places. For example, Ireland is a place where the corporate tax rate is, I think, 12%. Let's look at the same number for Apple. I don't even have to calculate it. It's less than 10%. And if you actually look at the federal, if you had the breakdown, federal may even be zero. This is the total tax they pay. Why? We have a law that says if legally you earn something abroad, you don't pay US taxes on that unless you bring that money into US. So if you book most of your profits through Ireland, you're going to only pay the taxes in Ireland. And yes, you have to keep the money over there. But then again, these people make a lot of expenses. They don't ever have to bring them here. It's called repatriation. But it's a big thing between Democrats and Republicans. Democrats want to tax you wherever you earn it. After all, you are a U.S. company, and Republicans don't. Certain accounting companies have specialized divisions. I have a college classmate. He got his PhD from Princeton in economics. He used to be a socialist and communist those days. Then he grew up and I'm still a socialist, but he actually is a partner in Deloitte and Touche, and his specialty is so-called transfer pricing, which is a euphemism for your clients. You figure out the optimal allocation of taxes, how you book stuff so that the taxes are minimal. I mean, he makes before bonuses more than $1 million a year just to do that. If you're going to be a CPA, be something like that. Doing taxes of people is not going to earn you $1 million. But corporate taxation, that's different. Generically, we're going to write net income as revenues minus costs other than depreciation, minus depreciation, minus interest, and we're going to multiply that with 1 minus tax rate. So whenever I give you a problem that says, go ahead and calculate the net income for me, given the revenues, cost, depreciation, interest, and tax rate, that's how you're going to do it. We can do a few identities. Net income is EBT divided by 1 minus tax rate. So if somehow I told you earnings before taxes and tax rate, you needed to know net income. That's how you do it. And remember, EBT is also